Okay, let's give people a few moments to get going, and then we'll start and have some fun.
Sounds good. Looking forward. I always remember they say when on radio, you always never wanted to have dead air time, but I guess we're not.
I think we're on right now, actually. Maybe
We are.
maybe we should start talking.
I
Okay.
think so. That's a good idea.
Well, first, let's welcome everyone for joining us on our monthly webinar series here at West End Wealth Planning. We hold these every month, except in the summertime, and they're designed to be educational. Talk about things that actually really make a difference for people in terms of their finances. And what we try and do is alternate between business owners session, which is today. We're going to talk about business owner tax ideas and non-business owner ideas. Next presentation is on, I believe, the November 10th, which is a Wednesday at 1 p.m. It's going to be year-end tax planning strategy. So that's for individuals and families. So certainly don't want to miss that one. So today we're going to talk about the business owner's tax reduction blueprint. And we're just going to do a quick summary, everyone, about what we're going to be chatting about today. I'm going to talk about how you can save up to about $45,000 or more in Canada Pension Plan contributions and health tax payments that you don't have to pay in certain circumstances. And like anything, when you're doing, by the way, with financial or wealth planning for business owners, planning is the key. A lot of the concepts we're talking about require a lot of conversation to see if they are appropriate for you. Now, so that's the first thing. We're going to try to talk about saving a big pile of money that you don't need to put out the Canada Pension Plan. Next thing, we're going to talk about why business owners really look at RSPs often from the completely wrong point of view, and they miss the big points. We're going to talk about that. Then we're going to talk about the super RSP for business owners, allowing much higher contributions, much more tax deductions, much bigger pension. That's going to be a significant part today. Then we're going to talk about how you can withdraw money from your corporation tax-free. And tax-free, Akiva, those are our two favorite words, tax-free. Yes. Either now or in your estate. So two different strategies involved can be big tax savers. Again, require a significant amount of planning. And the last thing, we're going to talk about another tax-deductible pension that you can add over and above your other plans. And this is it's kind of a niche market product, but the savings with our rising tax rate environment can be very substantial. So, by the way, I just want to mention a few things. This is from the Fraser Institute. And Akiva, by the way, I'm Paul Barreca. I should introduce, and this is my associate advisor, Akiva Ames.
Hello.
And we're going to have a chat today. By the way, during the presentation, if you have questions, by all means, go to the Q&A button on the bottom and feel free to ask your questions. Can't guarantee we'll get to them. We'll try maybe during the presentation or at the end, but feel free. We want your questions. We'll do our very best to get to them. Just a quick bit of information from the Fraser Institute. The average Canadian family between, I remember reading here, between 1961 and 2020, their taxes from all sources, so it's not just income taxes, it's GST, HST, gas tax, everything, increased by 1,992%. Now, at the same time, people think, well, housing costs have gone up huge in that period. They've gone up 1,671%. Your taxes have gone up much more. Clothing has gone up 629%, food by 767%. Taxes have by far the biggest rate of increase in any of those three categories. And by the way, on average, the average Canadian family, which I believe according to the Fraser Institute earns about $92,000 a year as a family, pays about 37% of all their income in various forms of taxes. That's less, or I'm sorry, that's more than food, clothing, and shelter combined. Now that figure, that's from 2020. It's a reduced number. It was over 40%. The COVID pandemic dropped that down, but you're still paying more. It's your biggest expense. It's massive. So, and let me ask people in the audience, I don't know anyone right now who've just had a new government, a liberal government backed likely by the NDP, two socialist two left-wing parties. Does anyone out there actually think the taxes are not going to go up in the future? You know, Akiva, we've had massive government spending, and it's continuing, by the way. We're looking, there's talks about increasing the capital gains inclusion rate. Income, I mean, there's no ending to where governments can try to get a nickel here, a nickel there. And so again, these taxes are almost certainly to go up in the future. And that makes planning even more and more important. If you're a business owner, you know, a business owner is an much easier target for governments to increase taxes than individuals. So again, we're going to talk about things today that make big sense. And by the way, just wanted a quick mention. One of the things when you talk about wealth planning is that everyone is different. Everyone is unique. Because wealth planning and planning to save taxes is not all about spreadsheets. Because we're all human beings. It's about knowing your values. For example, I can have 10 different business owners in front of me, all in fairly similar circumstances, similar points in life. But the strategies that make sense for them might be different because they have different values on money. They grew up, maybe some grew up in scarcity, some grew up in abundance. What are their backgrounds? What have they been reading? What have they been absorbing through the media? It all molds our attitudes towards money. I mean, I've had people, Akiva, you've probably seen this too. I've had people come to the office, usually individuals, but sometimes business owners. And they say things like, I don't mind paying taxes. I figure, you know, government needs the money. Not concerned about it. Whereas other people, completely different. They want to save every penny they can possibly save from giving to the government. So again, it's all different. Excuse me. Oh boy. Oh, excuse me. So again, I want to ask everyone, please feel free to go to the Q&A button below, ask your questions. If you'd like to chat with us, and if you hear some things, what often happens is people go through these webinars, they hear some things that maybe they aren't aware of or they're interested in, they go, hey, I should talk to someone about that. You can send us an email at info@westendwealth.com, info@westendwealth.com. In my understanding, that will be up on the chat screen. That number will be up there. And you just say, hey, you know, can we chat about this? Be happy to do it. So just a quick introduction, West End Wealth Planning. For those of you who aren't aware who we are, we've been in business for 30 years. We focus with a focus on the business owner, and we believe in taking a big picture. I think this is key. I've seen hundreds and hundreds and hundreds of business owners. Some of you may know I've done radio work for 20 years on CFRB and so forth. And what I found in meeting these people, it's quite common that they want to do something, but they don't get around to it. Here's what typically happens. If Paul, yeah, I know I want to get involved in this. I want to learn more about this strategy. Let's sit together. I'm too busy right now. Call me back in 6 months. Well, guess what happens? Akiva, what happens more often than not when we call back 6 months later?
They're typically pretty busy and tell us to call them back in another 6 months.
Bingo. Oh, too busy right now. Call me back in another 6 months. We call back in another 6 months. Guess what we hear? Too busy.
It's the same thing again, and then you never work on it. You got to put something in your calendar to make it work.
We actually have clients like this. We're trying to help out. You got to make time to spend time on your business rather than in the business. Of course, as a business owner, most people are very busy. They're putting out fires. They're trying to develop more business. They have all sorts of things that are happening. It's hard to find time to do things. But by not finding time, you're spending all that effort and you're throwing away money likely. You're giving it to the government that you don't need to. So that's a little bit about us. By the way, we think, again, a big picture. It's not just, and there's another common thing that we hear from clients, and we're going to get going here, is that we hear things like, oh, my portfolio is fine. Your portfolio is important, but that's just a part of it.
Mm-hmm.
To do proper wealth planning, it includes your taxes. It includes your retirement planning. It includes your estate plans. It includes your succession plans for your business. and they all work together. In other words, what we often do, a lot of the tax strategies we're going to talk to today are dependent on what your retirement plans look like, because that drives the strategies elsewhere. So it's just not your portfolio. It's a big, big picture thing. And, so again, let's start now, Akiva.
I think so too. Let's get into the meat and potatoes. So Paul, we've spent a lot of time putting together the tax reduction blueprint. Why do you feel it's so important for business owners to be aware of all the strategies that are open to them and decide if they can implement them or not?
Well, it's key because, again, I don't think a lot of business owners really understand what they're missing. For example, as again, we've met hundreds and hundreds of business owners in my time in office. And what we find is we'll ask them how things are going. And they'll say, everything's good. Portfolio is fine. I got my accountant. We've looked at all the tax strategies until we look ourselves. And we find things more often than not, we'll say, what about this? Has anyone talked about this? What about that? And people look, well, no one's really talked to me about that. They don't know what they don't know. And I'll give you my theory as to why that happened. Matter of fact, not my theory, I'm pretty certain about this. What happens is oftentimes business owners have been dealing with an accountant or a wealth advisor for quite a number of years, maybe decades. Good person, probably does an okay job on their portfolio, nothing wrong. But during that 10 or 20 years, the business owner's financial life has gotten more complicated and more complex. And they've actually outgrown their advisors, and they don't know it. That the advisor can't move forward with the next step, with the next strategy that makes more sense in a more complex situation. So again, that's one thing we strongly suggest. You want to make sure that your advisory people, your wealth advisor, your accounting people are in step with who you are. There's a good match between the two of you.
Yeah, so Paul, you mentioned, I know meeting so many business owners, and I actually used to listen to you on the radio before I joined your firm, and I always enjoyed listening.
Never told me that. You never told me that.
That was why I was so excited to come in and meet you. But you said you found a lot of common situations. Did you want to cover that a little bit?
Well, again, common situations really is that, again, people often realize they don't know what they don't know. Or another thing, a great quote from Mark Twain is, it's not what you don't know that doesn't hurt you, it's what you know for certain that just ain't so. And, and that's true with all of us, not just business owners, it's true of all of us. We all have our own beliefs. Oftentimes you got to be open and say, hey, things are changing. Here's what you got to think of too. As our lives change, our needs and wants and desires change. They all evolve. What our listeners are listening, or are right now listening, what they wanted maybe 5 or 10 years ago is maybe very different than what they want today. At the same time, our world around us changes. The economic situation changes. Boy, has it changed. The taxes change. That's why wealth planning is not a one-time event. Wealth planning is a lifetime situation that requires regular review, just like your health. You go get every year, you go for a medical checkup because stuff changes. Stuff changes in your life and the world around you. It's a lifelong situation that requires constant change, constant upgrading.
Okay, so Paul, let's go on with one of the teaser points you started off the presentation with, and you said some people are paying CPP premiums and they're not getting any benefit. Can you explain
this
a little
is great. Well, CPP is not like your RSP or your investment account, which the more you put in, the more you generally get out. With Canada Pension Plan, it's different. Once you put up to the maximum amount in Canada Pension Plan, once you've worked long enough and you put up to what's called the yearly maximal pensionable earnings, you put that amount in during your lifetime. If you put more in, you get nothing out on the back end, get nothing else. And I'll give you my own specific situation. And this generally starts around 60 years age. And this is one of the things that we bring to our clients. Business owner clients who are in this situation. Again, this only applies to business owner. If you're employed, you can't do this, unfortunately. So let's talk first. How much are you paying towards Canada Pension Plan right now? And this is Akiva got this information in 2021. If you're a business owner, you're paying both the employers and the employees side, which is about $6,332 a year. But that's going up every year, by the way. And by 2025, that number will be $8,265, a big increase. Now, here's my situation. When I was 60, I went to my CPP website, and everyone listening should have their own government website set up so they know how much they're going to get from CPP and so forth. By the way, it's really easy to get into. And what I did, I says, okay, I says, if I stop putting money in right now, what pension would I be eligible for at age 65? And it gave me a number. And it was virtually the maximum because I started work at age 21. So I had virtually put in all of my required Canada Pension Plan benefits or contributions. And what I found out that if I would continue to put contributions for the next 5 years, I would have put in probably close to $30,000. And guess how much extra annual pension I would have got out of my $30,000. And this is my real numbers, by the way. I think I told you, Akiva, but I'll share it with the audience. I would have got an extra $23 a year, not a month, a year. So this is one of the things that people are missing. They can stop their Canada Pension Plan contributions. By the way, to do this, you have to stop paying yourself a salary and you have to start paying yourself dividends. We're doing that because you don't pay CPP on dividends. Now, there are some pros and cons about this. So we're going to chat about them shortly. The other thing is when you pay yourself dividends, there's something in Ontario called the health premium, which was introduced a couple of decades ago. And essentially, if you earn more than about $20,000, and I'm reading Akiva got this information for me. Thank you, Akiva. Mm-hmm. Under $20,000, you pay nothing. When you go up to an income of over $200,000, you pay $900 a year. And so by paying yourself a dividend, again, you can avoid paying that health premium. And again, it doesn't reduce what you can take out of the health system. So now, what are the pros and cons of this? Well, pros are you can save a lot of money and still keep all your benefits. And, you know, that's pretty good. I like that. Now, the disadvantages are that you're going not to be able to accumulate more RRSP. And so that is a disadvantage. I look at this and I say, look, I'm going to save $7,000, $8,000 or more in the future, $8,000, $9,000 a year on this. That's well worth it. I'd rather take those funds and put them somewhere else rather than worrying about the RSP at that point, because it's such a big saving. I don't want to put money into a pension system that means every dollar I put in, I get nothing back out of it. And if you're a business owner, you should be looking at too. By the way, these are things that your wealth advisor, if you're in that situation, 60 or above in business, your wealth advisor should be talking to you about this. If not, I would start wanting, am I with the right wealth advisor? Have I outgrown this individual? So that's the thing. Again, you don't have to pay it. This starts right around age 60. Again, it depends on when you start working. I started working at age 21. So I basically put in all my money. You don't have to put more money in and get nothing out. To me, it's not fair.
Paul, another item, we often hear when we talk to RSPs, to business owner clients, is they say, I don't mind. I don't care about saving taxes now because I'm going to turn 72 and I'm going to have to pay taxes then. Why is that a misconception? What's wrong with that argument?
Oh boy, we hear that all the time. Why would I put money into an RSP? You got to take it. My mother's forced to take money out and it has to pay tax on it. This is lousy. Only problem is it's wrong most of the time, and it doesn't. It's the math tells you it's wrong. And by the way, just want to remind everyone, we have a Q&A button at the bottom, and you can ask questions there, and we'll do our very best to answer them the best we can. So that's right at the bottom. But you can do this anonymously, by the way. If you don't want to give us your name, that's perfectly fine. Just ask the questions. We're right at the bottom there. And again, if you have questions you'd like to ask us off air, you can simply email us at info@westendwealth.com. And if you look on the chat line there, that website or that email address is there, so you can get it right there. Okay, Fantastic. So yeah, here's the problem. Now, there's two ways to look at this, because when you put money in an RSP, if you put $1 into an RSP, you have $1 invested. However, if you put money in a corporate account, you've had 12.2% tax paid on that. So you're really putting in 87.8 cents. As an individual, and we actually hear this more from individuals, depending on your tax bracket, you might be only putting in 50 cents. So you have to compare putting in 50 cents versus putting in $1, and that's not done. People forget about the tens or maybe hundreds of thousands of dollars that are saved through tax deductions by using something like an RSP. That's thrown out the window. It's not, you're comparing apples and banana peels when you do that. Again, the simple math tells the truth. You have to take this into consideration. But there's much more than that. There's the tax deferred growth. Here's a situation, Akiva. How many times do we run into this situation? Someone has a passive investment account in their business through their holdco. We built up some assets, and there's an unrealized capital gain in the position. And we look at it and go, well, really, that's maybe not the best position for you anymore. We should consider changing that position to another position for whatever reason. But that's going to create a big tax liability. And it could be sometimes in the tens of thousands of dollars, depending on the amount of money we're looking at. So now the client has to decide, do I want to pay this big chunk of tax today or not pay it, but hold an investment position that might not be as attractive for me in the long run? So these are the types of things that you run up against that you don't have to worry about in a registered plan. No problem. You want to sell that investment, sell it, no tax consequences. This is much more significant than many people realize. And over the long run, this means you avoid that erosion of through taxes that happens in a non-registered account. Oh, by the way, you know what? I wanted to put something up here that I forgot, and it helps explain tax. It helps explain tax rates and why this is so important, especially dealing with a passive investment account. I'm just going to share the screen here for everyone, and I'm going to put this up right here, and hopefully this works. Did it come up there, Akiva? I think we have the shared screen. Okay. Yes. So I'm going to make this a little bit bigger. So this represents here, I'm going to draw here, this represents marginal tax brackets. Not much of a drawer with a mouse here. Sorry about that, everyone. And you could see these go up as your income goes up, and you pay the top marginal rate of 53.53% once your personal income is over $220,000. But before that, you pay a much lower rate. Now, compare that. I'm going to stop sharing the screen now. Compare that to someone who is in a corporate investment account. There, you pay from $1 on income, you pay 50.17%. The first dollar, you pay 50.17% on an annual basis. There's no deferral. And again, you don't get the advantage of those marginal tax brackets. Very, very key. Now, you get some of that money back when you draw money out of the account down the road. That's decades through something called the refundable dividend tax on hand. Again, different situation. So people often don't realize this, and they also don't realize that the worst tax is on interest income and net rental income. People often have, they have often a commercial building or sometimes a condominium, and they own it by the corporation. You want to realize that net rental income is taxed at the highest possible rate. Again, doesn't mean you shouldn't own the property, but it's something a lot of people really aren't aware of. So I just want to bring that up because a lot of people really aren't clear on that. Now, let's talk about the different types of income. And I want to talk about how it compares. Because again, people say, I'd rather put my money in my corporate passive investment account rather than a registered plan like an RSP. It's better. As we talked before, people say, I'm not forced to take money out, which is a benefit, but I save money down the road. The math doesn't always bear that out. Let me go here. And this is information done by our friends from the McKinsey Investments Tax and Estate Planning Department. And what this does, before I get it on the screen, it assumes putting in the same amount of money into an RSP and taking into account all the situations, the tax deduction, the small business tax rate, et cetera, et cetera. But it compares different types of income. So for example, let's put the screen up. I'm going to share my screen again here. And again, okay, let's see, there we go. Share the screen. Is it okay, Akiva?
I see it. Maybe a drop bigger, but it looks okay.
Whoops.
Oh, now it's sideways.
No, uh-oh. That's okay. We can fix that. Okay, there we go. So what this points out here, it looks at the amount that you have at the end of the day after tax. And remember, after tax is the only important number. Pre-tax number, it doesn't have a lot of value. This assumes we put money investing in an RSP or in a passive corporate investment account. And it takes a certain amount of pre-tax value, again, because investing with an RSP, you have more money up front. And it says, okay, at the end of the day, at this, you're going to have about a little less than $30,000 of after tax in your pocket. That's the only important thing. Now, if you invest corporately and you invest in net rental income, foreign dividends, or interest income, because that's tax is so onerous in your passive investment account, you actually have a lot less money in your pocket. You'd have a lot more with your RSP even after tax. Now, there are some caveats here. If your tax rate during retirement are higher, this may not be the case, but that just brings the importance of planning. Again, if you have a balanced portfolio that most of people do, which would be provide a balance of unrealized gains, dividends, and so forth, you're still going to have less money than your RSP. There is one situation where investing in a corporate passive investment account is going to provide you with more after-tax income, and that is if the entire amount is in deferred capital gains. So if you bought a stock that paid no dividends and you held it for 30 years, or you owned a piece of real estate that never paid net rental income, this is a situation. The problem is that that's rarely the case. And again, if you own a liquid portfolio, that means never making a change in your portfolio in 20, 30, 40 years. The chances of that happening are it's not really practical. So in the majority of cases, you're actually better off putting money into an RSP than putting it into a corporate investment account under the corporate rules. Now, those who may be aware that there's been changes in the corporate investment structure that made it less advantageous once you get more income. That's beyond the topic here and the time we have today. Again, that's something that requires planning, to sit down with your advisors to plan. And this is another thing, just a bit off topic. People often come to us and say, how do we plan our income? And they may have income from various sources, corporations, RSPs, pension income, real estate, wherever. That's where the planning comes in. How do we build this income to come to you at the right time in the most tax efficient way possible? And every person is different. Okay.
Yeah, and then just to stick in one thing, I mean, we often have chats with our business owners, clients, accountants once a year on this very topic. What's the capital gain situation in the corporations? Should we be triggering? So this is something that we often we always discuss with our business owner clients. So your advisor should be having that discussion with your accountant, because it's very important. You don't want to get back into a corner where you have to trigger a huge amount of capital gains 1 year because someone hasn't been monitoring it year over year.
Great point, Akiva. Again, this is something, because you have people, business owners, complex situations. Now, if they have more than one advisor, you have your wealth advisor, your accountant, your lawyer, and they all should be talking. Unfortunately, it rarely happens. It rarely happens. So the wealth advisor does one thing, the accountant does something else. They don't know what each other is doing, and that's not a recipe for good things to happen. One of the things that we do is we talk to the accountant, as Akiva mentioned. We want to make sure we're on the same path to make sure the client ends up in the right position. Thank you for adding that in, Akiva. Good, very, very good point.
So you showed the chart, and really, you've pretty much proven in most cases it's worthwhile for a business owner to have an RSP. But certain people, they're maxing out their RSPs and they're looking for alternatives that, what can they do above and beyond an RSP to try and save themselves some money in a tax sheltered fashion?
Well, that's a good thing. We've already established that in most situations, you're probably better on an after-tax basis putting money into a registered plan than putting into a corporate investment account in most situations. But again, not all. That's where the planning is critical. I can't emphasize that and underline that enough. But there's something that could be called a super RSP. And this is something that's not paid to you personally, it's paid by your corporation, and it allows you to put much more money in than an RSP, fully tax deductible. It allows you to have a much bigger pension than with an RSP because you're putting a lot more money in. And it allows you in certain circumstances to have a huge one-time deduction that may be helpful if there's a big event that creates a big tax liability in your corporation. It's called an individual pension plan. Now again, this is a more sophisticated product. It's like any strategy. For the right individual, it works fantastically. For the wrong individual, it's not going to work out well and there's no benefit. And that's where the planning comes in because every situation is different. Now, let me just talk a little bit about this. First thing, rather than you putting money into, by the way, an individual pension plan is just like a defined benefit pension plan. Like if you work for the government, you get this defined benefit pension plan that is that provides a guaranteed income. It's backed by the government. It's essentially your corporation setting up one for you, except instead of the government being responsible for it, you're responsible for it. And whether rightly or wrongly, the laws for pension plans provide for much higher amounts of total contribution, more than 30% more than your RSP. I'll just put up another slide here. Let me just put up one other slide here. Slide number 3, just for fun. Bear with. By the way, we had people, some of the questions are asking, where do we go to the website for the CPP? Yeah, My Service Canada. Yeah. Okay, great. Okay, so that's taken care of. Again, you have questions, go to Q&A and we'll do our very best to get to them, okay? Q&A at the bottom. Or if you have things you'd like to speak to us individually about, just simply go to info@westendwealth.com and that email address is on the chat screen below. Okay, so let's share the screen. Let's see where we end up. And there we go. So this compares contributing to.
So I don't see, if you're sharing, it's not up yet.
Oh, that's because I didn't press the share button. There we go. Is that better?
Individual pension plan, it's up, yeah.
Okay, so this compares the amount of contribution that you can put into an RSP versus an IPP. And as you grow older, you can put more money into an IPP. It's one of the big advantages of growing old. You can put more money in. So for example, when you're 45, you can put 32,000 into an IPP versus only 27 for an RSP. That number gets bigger so that by the time you're 65, you can put 44 grand, over 44 grand versus the same 27,300. That's 17 grand more. That's a lot of tax deductible contribution room that you can put in. So that's the number one. And there's actually 3 separate areas where you can add in more fully tax deductible contributions. One is on an annual basis. The second is when you start the IPP, assuming you've been in the business for a while, you can have a catch-up. Now, I'm not talking about mustard and ketchup for a hot dog. A catch-up contribution. And what the pension laws allow you to do is go back and say, hey, you've been running your business for 15 years. If you would have started an individual pension plan 15 years ago, you'd have been able to put in this level of contributions. But because you put money to an RSP, you put in that much. And they say, okay, you can put in the difference today. or you can spread it out over up to 10 years. So again, you may have a situation where you have a big tax liability. Well, here's a way to shelter that potentially large tax liability with this large deduction. And by the way, this is all done corporately. It's not done individually. So again, 3 different ways you can put more money in: on an annual basis, as a catch-up, and when you retire at age 65, there's another optional life amount of lump sum contribution. So a lot more money in this. Now, some of the other advantages, again, put a lot more money in, much more tax deduction, much more pensions. Here's the big one: your management fees are fully tax deductible. This could be big. Let's say you have you and your spouse, you have $1 million in an IPP compared to an RSP. Let's say your fees are maybe 1.5%. That's $15,000 a year. Over 10 years, that's $150,000 of tax deductions. It's saving $75,000 at 50%. This is not small money. You can't do that in an RSP. You can in an individual pension plan. You also have some payroll tax savings. And there's another huge benefit, which is on the estate side. Now, let's talk about that for a minute. So, Akiva, when you have an RSP, your business owner, after you and your spouse are gone, what happens to all that money?
For the most part, unless there's somebody with a disability in the family, it's just taxable.
Taxable.
In the estate, it's taxable that year.
And taxable usually at the highest marginal rate, which is over 53%. Plus you may have executor's fees, plus you may have legal fees. I normally just assume 55%. So if you have $1 million, 55% for over $500,000 is gone permanently to the government. Now let's compare that to an individual pension plan where the succession plan includes sons or daughters, and the sons and daughters take over the business and have their own individual pension plan. Now, guess what? That's really, really cool with this. This is huge, is that the IPP, that $1 million can be transferred tax-free to the kids' IPP. That's over $500,000 in tax savings with this example. But again, this is not right for anyone. For example, for everyone, if you are looking to sell your business, at 60, 65, 70, you have no intention of your kids aren't going to come in, they're not interested, whatever. That is not a benefit. That's, again, brings back the planning. Is this the right strategy for you? That's where your wealth advisor should be sitting down, going through, getting to know you very well and understanding, and either saying, yeah, this is a good idea, but maybe not for you, or yeah, this is a great idea and this could save you and your family and your business a pile of money in taxes.
I think there was one more advantage, one last advantage you wanted to add, Paul.
Well, this is really cool because the IPP continues past your retirement and when you draw money out. So you could be 75 years old, still have your business or still have a holdco, and markets have a bad year, which they will. So your plan is in what's called a deficit. And again, it's beyond the scope here of what that entails. But you can now add more money into the plan over and above the normal contributions. And those dollars are fully deductible, of course, by the corporation. So again, some very, very big advantages here.
Now, so Paul, any disadvantages, by the way, with IPPs?
Well, yeah, I mean, we want to go through that. There's cost involved. But I have a question here. Can you start an IPP at age 69? Yes, that's the last year that you can do an IPP. And by the way, that's where an IPP can be very, very helpful. Let's say at age 69, maybe you're selling your business, but you're going to keep a holding company. You could have a massive amount of deductible IPP room that could potentially shelter a huge amount of taxes payable on the capital gain and sell your business. Again, that's one of the strategies that makes sense for some people, but not for others. Good question. Good question. Let's go into some of the disadvantages because there's always disadvantage to everything. One, there are some costs involved. Not a lot, quite honestly. The tax deductible fees more than pay for the cost. There's a bit of annual cost, and it's paid to an actuary because there's a lot of regulation. You cannot do spousal plans here, so you're not eligible to do a spousal contribution. However, the fact that now you can divide income at age 65 for RIF payments, that's not nearly as much of a disadvantage as it would have been a few years ago. It's a little less flexible, a little more paperwork. And again, it's not advisable. If you're planning to sell your business outright, say at 65 or any age, and you're not going to need a holding company or any type of a business, it's probably not appropriate for you because the IPP must continue on past when you sell your business. So that's much what IPPs. Again, this is something you want to sit down. Your advisor should be talking about this to see if it's appropriate for you or if it's not. It's not everything to everyone. It's everything to some people.
So you touched upon this a little bit earlier, Paul, and we found that there's a huge interest in estate planning and reducing taxes that are payable in a person's estate. So you mentioned a little before that IPPs are advantageous with trying to protect part of a person's estate.
Well, I think we talked about that, Akiva. That's where if you have
you touched upon it a little bit earlier.
Yeah, that's it. If you have other your children who are taking over, working the business, they have to have their own IPP. With that, on the estate, the money can transfer tax-free to the kids. Massive, massive, massive benefit there. I actually have a quick question here. This is from Scott, who talks about, is there a minimum amount of time you need to own a business to set up an IPP? Not really, no. You can start up a business and get going right away. But if you start up a business this year and start an IPP, there'll be no past service contribution because the business was not there up until this year. But there could still be benefits moving forward with that. Okay, probably want to go on to the next part.
Okay.
Here.
Okay, perfect. So we often find that there's a lot of business owners that are holding lots of cash in their corporation, which they don't really need to run the business, but they just don't want to take it out because they don't want to have to pay themselves dividend tax on it. So what do you suggest people do in that situation?
Well, it's a good question, Akiva, and this is a situation that comes up. There's really two ways here. There's actually a number, but here's a couple of important ways that often are neglected. And that's using something called the capital dividend account, or the CDA. And this is a notional account that's only available in Canada. You can't do this in the United States. And now there's two ideas here that can be very profitable from a tax perspective. One, I'm going to talk about how you can use your passive investment account to draw money out of that tax-free from your corporation today. So let's say you have a passive investment account. You have a position or a number of positions in there that have unrealized capital gain. You decide to sell those. And let's say, for example, you sell them and there's $100,000 of capital gain. That would mean there's $50,000 of taxable capital gain and $50,000 is tax-free. The exact same as if you own that personally. The neat thing is that $50,000 that's tax-free, if you have to trigger the gain. You can take that out of your corporation, tax-free, take it into your hands, put it in your bank account, use it to buy yourself a new car, whatever you want with it. So this is often underutilized in my experience by individuals. Again, it's not perfect for everyone. People may have capital losses and so forth. Every situation is different, but it's one of the big advantages that's available. The CDA drawing out the tax-free portion from a passive investment account. Second area, you can use that same CDA or capital dividend account. And this is, we're going to talk about something here that when some people hear it, they just shudder. We're going to talk about the use of corporate-owned insurance. Now, Akiva, what happens when we talk to insurance to some people? What's the reaction we get?
I don't believe in insurance. I don't want to pay for insurance.
Exactly.
Anyone half a dozen excuses. I don't
like
need insurance.
I don't want to pay insurance. But what if that insurance plan could save you and your family tens and hundreds of thousands of dollars of taxes? And here's again where the planning comes in. We talked before at the beginning of the program how the retirement plan often drives a lot. Let's say you're in a situation where you've been successful, you've worked hard, you've got money here, there, and we do a retirement plan, and it says, you're never going to spend all your money. You're going to leave a big estate to your kids, to your grandkids, to charities, whatever it is, it doesn't matter. You're going to have way more money than you need. And I say, well, so you have all this money now in your corporate investment account. We can either leave that where it is, and it'll be taxed every year, by the way, and remember that 50.17% tax rate. And at the end of the day, we can calculate how much will be left in the estate, excuse me, on an after-tax basis. Or if we put the exact same amount of money into a specially designed estate bond corporately owned insurance plan, that could multiply the amount of money left in the estate by significant amounts after tax. Remember, the only important dollar is an after-tax dollar. So what people are telling, Akiva, as you brought up, when people say, I don't want to pay insurance premiums, if that program is advantageous for them, what they're really saying is, I don't want to pay the insurance company $1 in premium, even if it's going to save me $2 in taxes. I'm not going to make that investment. And it literally comes down to that, because when you have corporately owned insurance, the proceeds can go out of the corporation without tax through the CDA. Now, there is a few nuances in that, but in general, that's the case. You're getting that money out of your corporation with no dividend tax. It's incredible. The benefit that can be derived from this is quite incredible and very, very misunderstood. So again, that's a corporately owned plan. It's not right for everyone. Now, I have just another question here. I'm not sure this. I donate to various charities from my corporate account. It's not really a question, so I'm sorry. I can't really answer that. So those are a number of the questions. Now, there's one other area, Akiva, that we want to chat about. We're getting near the end of the time here.
The end, right? So you were saying, as you said at the beginning of an introduction to the presentation, that there's another structure for a person to provide an enhanced pension. So
yes, this is something that's a very niche. It's not available, but if you're in a situation where you're so successful that you're bonusing down every year, you have to get down to that $500,000 of profit to stay in the small business tax rate. You have to bonus out a significant amount of money to yourself that you don't necessarily need. More than half it's gone to tax. There's something called a retirement compensation arrangement, or an RCA, that allows you to put that money in a registered plan. And there's actually no limit you can put into it. Now, there is a bit of the way this works is you have to give half of the money up front to the government, but it's in a refundable account. So that money you'd be given to the government anyways, never seen again for the rest of your life. Here you can put that into an account that when you retire, you get it back. Now, you don't earn any interest or any growth on it, but you still get it back. But if you pay taxes, you get nothing back on that. So this is it's a fairly sophisticated product. It's a fairly limited market. But again, if you're in this situation, your advisor should be talking about this to see if it makes sense for you. So now we're getting to there. I just wanted to kind of review now. Any other questions from you, Akiva, before we just kind of do a quick review?
There was one more question. Someone just posted another question. That's probably a pretty good question.
Can you explain the difference between eligible dividends and non-eligible dividends? Good question. Eligible dividends are from Canadian-controlled public corporations. So if you own Bell Canada, they send you a dividend. It's an eligible dividend. Non-eligible is if you own a corporation, you pay yourself a dividend that's non-eligible. There's a higher tax rate on the non-eligible dividends, but in effect, it's the same, because that public company, Bell Canada, paid a higher tax initially on the dollar of profit. So to take it out, you pay a lower tax. With your non-eligible dividend, you paid a lower corporate tax and a higher tax when you take it personally. It works out almost the same. But for you, That's the difference. So, okay, just quickly now. So we've gone over a lot of things today. And again, a lot of it, I can emphasize, the planning is key. With a business owner, it's not as simple as throwing money into an RSP. It's a big picture thing. You want to do this properly, you need to look at your retirement planning, your tax planning, your estate planning, the portfolio planning, your tax rates now, the anticipated tax rates down the road. You need, what we find again, many people are dealing, they've outgrown their advisor, and they're not dealing with these things as they should be. So we talked today about several things. We talked about how you can avoid paying up to 45 grand in Canada Pension Plan premium and health taxes. Big savings without any loss in benefits. Again, if it's right for you. We talked about, let me just go through here in my notes here. We talked about the misconceptions many people have on the after-tax benefit of an RSP versus putting your money in a corporately owned investment account. We talked with it in the majority of cases. You're actually better off with that RSP, even though you pay taxes down the road, you still have more in your pocket than you would have by keeping it in a corporate account. Then we talked about the advantages, some of the advantages of the registered plans, such like deferral and so forth. Then we talked about the super RSP for business owners, the individual pension plan, how it allows you much more contribution room, how it allows you tax deductible fees, how it allows you, actually, this is one thing that we did not talk about, full creditor protection. This is by statute. It's better credit protection than your RSP. And for some people, that can save their life. The old joke is that's why O.J. Simpson has money to live today. They couldn't take away his NFL pension. Can't take pension money away from you. The huge potential estate benefits in the IPP, and the fact that you can add more money, tax deductible money if markets turn. Hey, that's an optional type of a thing. We talked about that. Then we talked about ways to draw out money from your corporation on a tax-free basis, either now by taking the tax-free portion of a realized capital gain and using specially designed estate bond corporate insurance, where you could multiply your after-tax estate by a significantly large amount of money. So that we talked about that. Then we talked about a niche market, something called the retirement compensation arrangement, that allows business owners, if they are in a situation where they have to pay themselves a large bonus to get below that $500,000 threshold to keep in the small business tax rate. This is something that might make a lot of sense for them. Again, all of these require planning, they require expertise, and they require a little bit of time to determine, are they right for you? Are they not right for you? So again, I think we've still got a couple of questions on here. Where is the, I think that was one earlier. Where is the T2, the dividend payment from CDA is reported? I got the answer. It's Akiva, do you know that question? That's something the accountant normally gets involved with.
You got to talk to your accountant about that. I think they have to file a special election. They'll probably charge you a little bit of money for it. So typically they won't do a CDA every year. But yeah, that's something your accountant would tell you and take care of.
Yeah. By the way, that's a good question, because oftentimes people say, my tax planning is fine. My accountant takes care of all that. Your accountant does a lot of great work, necessary work, a lot of work that us as wealth advisors don't do. But what many people don't realize is, while there is an overlap, there's many things that your wealth advisor does that your accountant is not trained, not licensed to deal with. These types of structures. We actually go into accounting firms and do lectures on how these work to educate them on these types of structures. So you need both on your team if you're in a situation like that. Just moving to the end. What else? Summary, questions. If you want to talk to us, if you say, hey, I've heard some stuff that maybe, I'd like to learn more about, see if they can help me out, just send me an email at info@westendwealth.com, and that is on the chat screen. Our next presentation is on Wednesday, November 10th, and it's on year-end tax planning strategies for the individual. So in case we've got a few more minutes here. Let's, any more
There's
questions?
I see one more question got posted. Which
Yeah,
companies-
there's something in the chat line here. Let's see.
yeah, the Q&A, which companies provide IPPs for small companies? Well, we open up IPPs, most investment corporations will open up an IPP.
Yeah, here's just something. If you have a $100,000 in your RSP and you're getting 10% return, can you take that 10% return out of the RSP and have it as income in a corporation? No, if you have that money in an RSP and you take it out of that RSP, it's taxable to you personally. Nothing you can do about that. So there you go. Any other questions here? Which companies provide IPPs for small business? I think you chatted about that. Yeah. It depends. The concept that we're talking about here for our clients, we're talking to the business owner who sets up an IPP for themselves, their family, their spouse. Now, you can set up an IPP for maybe your senior employees, and that may be used as a way to keep valuable employees in the firm, because you can put more into that IPP plan than they could normally put into an RSP. But the majority of cases in our situation is that we will go in and our clients, if the IPP is a suitable situation, if they want to put in more money than they can in their RSP, they want to have the creditor protection, they want to have the tax deductibility, the fees and so forth, and the small extra cost and so forth is not an issue for them. That's where we will generally go in and do this. And again, you want to deal, again, I can emphasize this, people who have experience with this. At our firm, we set up our first IPP in 2001. So I've been doing this for 20 years. And because there are a lot of nuances with a lot of these strategies, you want to make sure you're dealing with the right people who understand them, that can properly advise you. Okay, I think we're getting down near the end, unless we have another question or so here.
I see another question over there, but I'm not sure.
What happens with the IPP upon the death of a shareholder? Well, I'm assuming that we're talking about the IPP upon the death of the business owner. Just like an RSP, the balance can transfer tax-free to the spouse. Once the spouse is gone, then unless there is children in the business who have IPPs also, then that money is taxed just like an RSP is. So with that being said, I think we're going to close things up today. Listen, thanks everyone for joining us. I hope you found this valuable. Please, I'm happy to get your comments at info@westendwealth.com, or if you'd like to chat with us and just set up maybe a quick 5-10 minute conversation, see if we can help you out. That's great. info@westendwealth.com. And I hope we see you back in November on the 10th for our year-end tax planning strategy seminars. In the meantime, Akiva, thanks a lot for joining me on here and helping me out and doing the research and so forth and all this. And I hope the rest of you, you've enjoyed the presentation. Stay safe, and we'll hope we speak to you real soon.
Always a pleasure.
Take care. Bye-bye now.